Good morning and welcome. Patriot Radio News Hour. Joe and Jason coming to you live on this Friday, wrapping up the week. And what a week it has been. A very, very strong week for the gold markets and the silver markets as well. And continuing that trend again this morning. And Jason, we saw the 10-year note explode higher yesterday, almost got to 4.1 yesterday. Mortgage rates well above 7%. To give you an idea of how fast things have moved in 6 weeks, take a $400,000 mortgage. Okay, so if you could find a house, and let's just say, after your down payment, you're financing $400,000. In 6 weeks, the payment on that $400,000 rose by almost $300 a month. And 1 year ago, the payments have now doubled from 1 year ago. So just kind of gives you an idea of what interest rates can do when you're talking about debt, right? When you need to take debt on. And I don't care if it's a house, if it's a car, if it's a credit card, student loan, you name it. Jason, things got a lot more expensive.
Yeah, and we don't really know where this thing is headed for sure. Everybody can speculate and have ideas of what they think's happening and look at history, and everyone can do their best guess. But we could be seeing mortgages at 10% here maybe later this year, for all we know. We could see it even be worse than that. Joe, it just depends on how the situation goes, and there's just a lot of factors that feed into where this market's headed. So the rates may not be stopping anytime soon.
You said something right there. I mean, it's hard to think about. I'll say this. I think, and this just, and again, we don't know, but 8% seems awfully likely, doesn't it? I mean, if we're at 7 right now, and of course, we saw all the latest inflation data, which suggest once again that the central bank is behind, that the central bank continues to misread the market. And again, is it a misread? Or is it simply, hey, you know what? We know what's happening, but if we raise the rates like we should, it's really going to make things even worse. And so we're just going to play this slower game. But everybody thinks, listen, at least 1 more percent. And to your point, hey, doesn't mean it's going to stop there. I mean, could we see, when I got our first loan, and my wife and I, we bought our house, and you guys have heard me tell this story. It's a $135,000 house back in 2000. And guess what? That was the average price of a home, $135,000. Now today, I started the show, if you can get a $400,000 house. I'm starting the show with that. Right? We went from $135,000 to $400,000. The interest rate then was 7.25%. That was our first loan. And a lot of people out there, they tell me, I remember my first loan, it was 10%, 12%. You think back, people that were buying homes in the late 70s, early 80s, they were paying even more than that. But 7.25%, that was normal. And at the time, you know what? I made okay money. I was making, $70,000, $80,000. And guess what? That was about all we could afford, at that type of an interest rate. So, again, it really is it's a scary thing right now. I think everybody's in sticker shock and everybody is going, okay, what's going to happen? The job market's hanging in there. Wall Street had a tough week last week, doing a little better this week. It hasn't been horrible, right? It's not like Wall Street's down 20% again, at least not yet. But Jason, I think everyone's waiting for the other shoe to drop.
Yeah, Joe, and with those numbers you were running, 10% on $100,000 mortgage from years past, that's an annual percentage rate. That's about $10,000. Whereas 8% on a $500,000 house, that's 40 grand. I mean, think about it, Joe. The balance is that prices are so high, and the inflation is really, you can say houses have appreciated, but it's not because the houses are so much more valuable. It's the inflation. That's what's happening. It's everything's so expensive. And Joe, that's 40 grand on an 8% on a 500,000. Because like you said, Joe, the first house you bought, you probably put some money down. You probably had about $100,000 or so. Yeah, 10%. That's not it. It's not as bad when the prices of things are reasonable, but things are no longer reasonable, Joe.
Yeah, and I think that's the killer. The killer is, as Jason said, things are no longer reasonable. And now when you throw the interest rate on top of it, it just puts everything out of reach, right? It really does. Cardone, when he was talking earlier this week about, hey, if you're a single digit millionaire, you're just middle class. That's it. That's all you are now. You are middle class. And it used to be, right? That always used to be the thing. Man, if I could just get $1 million, I'd be rich.
That is exactly true, Joe. That is on the money. I mean, you could have $1 million in assets and barely be scraping by. I mean, that's the truth of it. Especially if if you're buying a house, Joe, right? You could have all that equity sitting there, but what can you do with it nowadays, right? And what are you going to do? You still have to work 9 to 5 or even more just to pay for the food and the energy and everything else to support that place, right?
Yep. 800-951-0592. allamericangold.com is the website. We got a great fractional gold special coming up for you as well. Don't touch that dial. $800-951-0592. Joe and Jason wrapping up the week. A quick look here at the markets. Gold is up 11 here, 1851. Silver's up 20 cents, right at $21 today. The Wall Street's up today, up 130 on the Dow, 32 on the S&P, 120 on the NASDAQ, as the bond market, after that huge explosion yesterday, that 10-year note still sitting just above 4%. And I think going higher than a lot of people want it to be, me included. This market update brought to you by our friends at YRefi. Again, hey, you don't have to worry about it. With YRefi, you can get up to 10.25%. This all has to do with the private student loan market right now. Of course, the federal part of student loans is in the Supreme Court as we speak. Remember Joe Biden trying to just say, hey, don't worry about it. Here's 10 grand. In a lot of cases, you can get 20 grand. Just kind of tells you how big the problem really is. And think about, interest rates and how expensive. I don't even want to know how expensive it would be paying off these student loans if you got $40,000, $50,000, $100,000 in there. But check it out. Invest. YRefi.com. You got to have at least $50,000. You can use an existing IRA. Invest, the letter Y, REFY.com, or 888 YRefi 24, 888 YRefi 24. And Jason, very quietly, now this is going to be, I want to say, the third time I've mentioned this bank in not a good way. Credit Suisse. So remember, I want to say at the end of last year, I brought them up for the first time saying, hey, there's a problem with Credit Suisse. And of course, we found out later, our central bank, the ECB, they did a few market operations because Credit Suisse was violating the European version, if you will, of Dodd-Frank, their liquidity requirements. Of course, they had to raise a bunch of money, $4 or $5 billion. And then Credit Suisse CEO came out on TV. It's always a kiss of death when you go out on TV, when your bank's in trouble And you go out there, oh, no, everything's fine. Lehman Brothers did it. Bear Stearns did it. Now Credit Suisse has done it. And it was, 3 or 4 weeks ago? If that, I brought them up again. And people were starting to talk because the CEO of Credit Suisse said, hey, the bank run is over. In other words, clients stopped pulling money out. And then 3 weeks ago, we kind of found out, Jason, it wasn't over. Now today, Credit Suisse is at a new all-time low. They've had to boost. Listen to what they're doing to try to get people to keep their money in their bank. They're actually raising the deposit rate. So in other words, what they're doing is they're going to pay even more interest on the money that you have, like in your savings account and whatnot, to try to get people to not take their money out of the bank. Jason, that's not a good sign.
Well, I mean, it's the responsible sign. You're supposed to be giving some interest for those deposits, right? That's the way it's supposed to work. But no, I get what you're saying, which is, for the first time, I've seen some graphs where the deposits are going down in these banks for like maybe the first time ever for many of these banks. And because people are pulling their money out, right? Plus they're just spending their money, right? They don't have as much money to put in there. But yeah, Joe. So how do you keep deposit money in there? The only thing you can do is really raise the interest rates for savings, right? Or for those accounts. What else could they do, Joe?
Right. And you know what's so sad is they don't care about all of us regular folk. Okay. They don't. Oh, double it. Oh, you got 15 grand in the bank, or you got 10 grand in the bank, or 5 grand in the bank, or maybe at the end of the month you got $33.17 in the bank. No. They're going to give you 6.5% on a deposit above $5 million. Why refi starting to sound pretty good, isn't it? Right? You don't need $5 million. First of all, you get up to 10.25, as high as 7%. If you promise to leave it in there for an entire year, which, by the way, now is obviously well above, especially in the Eurozone, what the EU rates are, and well above what the Fed's funds rate is here. To give you an idea, JP Morgan, they pay 5.25. By the way, the minimum $15 million. Who the heck has $15 million in the bank? Why would you do that?
I was going to say, man, that doesn't sound so bad. Maybe I should put some money in there for a year. But then of course, the requirement kind of takes me out.
$15 million. Hey, you're insured for, wink, wink, nod, nod for $250,000, but put the $15 million in. Citigroup, 5.2% for $10 million. And UBS says, here, I love this one. UBS, about 5%. What about? Well, what is it? Right? Well, we pay about 5%, but you got to have $5 million. Just kind of gives you an idea that, and again, it's worrisome. And like I said, we know this. We learned this the last time around. It only takes one of them. Lehman Brothers started it. Need I remind you, what was Ben Bernanke saying before Lehman Brothers? Oh, it's a subprime problem. Oh, it's containing. Oh, it's a little frothy. What's Jay Powell been saying? Oh, it's transitory. Oh, wait, it's disinflation, right? We're getting, hey, it's not the same issue, but it's the same thing. Once again, the central banks ignoring facts, creating seasonally adjusted numbers that somehow support their hypothesis, which isn't rooted, like I said, in any facts whatsoever. Today, we got service sector PMI. Remember, yesterday we got what? Manufacturing PMI. It was a disaster because it was reigniting of inflation plus negative growth. On the service side, reigniting of inflation. At least they Jason, they got just in to the quote-unquote growth side, but both sectors saying inflation has roared back once again.
Yeah, inflation. It's going to be what we talk about pretty much every day until there's a real lessening of it. And Joe, real quick on the interest being given on those accounts from Credit Suisse, it's doesn't it feel like a trap? Hey, put your 15 million in here, because what happens when a Ponzi scheme is failing, Joe? They make bigger and bigger promises to put your money in because they don't have enough money to support the Ponzi scheme. Isn't that what it feels like? That's what it feels like, Joe. It feels like, talk about Lehman Brothers. Hey, when things are starting to fall off the cliff, they'll do anything they can to float that boat, won't they?
Well, and then here's this. And again, it's early. We talked about bankruptcy filings, the second highest level of big companies filing bankruptcy in the month of January, only behind the 2009, right? Of course, 2008 started the financial crisis. Well, today, Blackstone, they now have defaulted on $562 million of commercial-backed real estate. What was it, a week and a half ago? PIMCO defaulted, I want to say it was on $1.8 billion. And here's the funny, Blackstone continuing to block investors from getting their money out of their $71 billion REIT. And now, Jason, starting to selectively default on these commercial-backed real estate loans.
See? And what do I get the feeling that this will be something that we'll be repeating over and over again in the coming months, Joe? It's happening. It's happening. It's happening a little slower than Joe and I thought it would happen in a lot of ways. But now I've been saying for about a year now, Joe, it just seems like this thing is going to grind on slowly. And it's what you do when you want someone to accept the inevitable, some bad conclusion. You just slowly try to lull them into accepting the fate. That's kind of what this feels like, right, Joe? Everyone knows it's going to happen, but it's just happening, and one step at a time, right, Joe?
You got to remember, they can't refinance. They can't refinance. They don't pay off these commercial loans. These are all adjustable rate, low interest, with balloon payments. The only way it works is the value of the real estate has to continue to rise. And then, of course, interest rates got to be at least somewhat close to what they were when you took out the first balloon payment. Well, now we've got a problem because A, interest rates aren't close. And now B, all of a sudden, the real estate is starting to be worth less. And this is a problem. By the way, Blackstone, the largest commercial real estate landlord in the world. This one happens to be a Finnish landlord. So in Finland, this tranche is now entered into default. And again, this is why I said Credit Suisse is we're going to have to keep an eye out. And it looks like, it's not a pattern yet. We need one more, right? It started with PIMCO. Now it's Blackstone, right? I'm sure somebody else is going to be next. Once that pattern starts, it's going to be interesting to see what banks are on the other side of this. And of course, as the next quarterly earnings reports come out from the banks, how big are these loan loss provisions going to be?
Yeah, Joe, in many parts of the country, the commercial real estate market is down 20%. It's actually down more than the residential. So that's what you said about refinancing. It's impossible. You can't have your real estate going down even 10%, interest rates going up, and hope to refinance anything. So yeah, it's a dead issue trying to get capital if your business is falling behind.
Yeah, today Best Buy announced that they're going to close at least 30 stores. We're going to start getting these now, right? We saw the retail numbers come out. They're now anticipating a big slowdown in sales. They're going to have to get those store counts in line. That's more empty commercial real estate. It's going to be interesting to see. Are we going to start seeing a lot more empty commercial real estate? And then, of course, obviously, Blackstone doesn't want people to get their money out of their REITs. Something worth watching without a doubt. And now we got more news on auto loans. We've been watching this one as well. It looks like, Jason, the repo man may be back in business out there. They're saying that U.S. subprime auto delinquency rates, it's at a new record high. It's at a new record high. Over 6% of subprime auto loans are now in default. Jason, that's a big number.
I remember watching The Big Short, and they're sitting there, when they're being introduced to what's getting ready to happen. Nobody knows what's getting ready to happen, and they had to get to 8% defaults, for foreclosures, right? And so you're talking in the car market, we're right there on the cusp of that, that's a big number, Joe.
How about this? The average auto loan now has a negative equity of $10,000. Wow. And I mean, I know used car prices came down a little, but holy smokes.